So what did financial markets do this week, and how does the latest macroeconomic data releases influence your investment decisions and conversations you and your family should be having? So the S&P 500 index is once again approaching all-time highs, and it's actually achieved its third consecutive week of gains. Market volumes were particularly low throughout the week, as any lack of real market-moving macroeconomic data seemed to have kept most traders on the sidelines. But before we get into the macro news and how it affected the markets, I think let's quickly just chat about the current developments in the Middle East. Over the weekend, Israel issued further evacuation orders to a significant number of Palestinians in Rafah, as it started to escalate its military activities in southern Gaza once again this week. Israel has stated its intention to continue with the planned operations in Rafah, despite some concerns from the US and other allies about the potential for civilian casualties as well as a humanitarian crisis. Reports from Israeli media also indicated that there were multiple rockets fired by Hamas overnight on Saturday. We do believe these developments, could put some further upward pressure on the oil price, which seems to have been forming a base of late. So moving across to the US, investors appeared to be primarily focused this week on the very unexpected increase in weekly jobless claims. This completely overshadowed other economic events we saw during the week. It was quite a bad number. The number of individuals actually filing for unemployment benefits increased to 231,000 in the week ending the previous Wednesday. And this actually marked the highest level since last August. In a very similar vein, continuing claims also experienced a reversal after we saw 4 consecutive weeks of decline. And in a further negative development, the University of Michigan consumer sentiment for May also experienced an unexpected decline to 67.4. This figure on its own is not necessarily that bad, but it is quite a bit lower than the final reading we saw of 77.2 in March. And this also represents the lowest level we've observed in the past 6 months. Both of these data points drove equities higher, as the market is now hoping to see the Fed actually cut rates earlier. So just looking at the market indicators, the Dow Jones Industrial Average led the pack higher, increasing by around 2%. This was mostly due to the outperformance of some of the value names that we saw. It was also followed by the S&P 500 with a gain of just under 2%, and the Nasdaq lagging with a gain of 1.51%. The yield on the benchmark 10-year US Treasury note ended the week largely unchanged, which was quite surprising because of the weak payroll and consumer sentiment numbers we saw. So moving across the pond to the Eurozone and the UK, European indices had a very good week. Most of them ended sharply higher on much better than expected corporate earnings results, as well as some increased optimism that major central banks would start cutting interest rates sooner. The focus this week, however, was on the Bank of England, as they actually maintained their key interest rate at 5.25%. But the interesting thing was that they actually started to hint at the possibility of implementing policy changes as soon as June. We even saw some of the voting members already voting in favor of a rate cut of 0.25%. This was well ahead of market expectations, and it actually marked the exit from the recession that began in the latter part of the previous year. Growth was supported by expansion in services as well as increases in production. So just looking at some market performances in local currency terms, the pan-European stocks Europe 600 index ended sharply higher with a gain of 3.01%. And particularly positive was Germany's DAX gaining 4.28%. The UK's FTSE 100, on the back of that positive data we saw out of the UK, also climbed almost 3% to hit a fresh record high. Then moving further afield to the Asia Pacific region, both Japan's Nikkei 225 index as well as the broader Topix index experienced slight declines over the course of the week. This was despite significant depreciation in the yen against the US dollar. It actually reached as high as 157 yen to the US dollar from its previous week level of around 153. And that was despite consensus amongst most market participants that the Japanese authorities had actually intervened twice in the foreign exchange market to support the Japanese currency. The concerning thing is that there seems to be indications of fragility in certain of the economic indicators out of the Japanese economy, and this could actually potentially postpone the Bank of Japan's plans to increase interest rates. In March, we actually saw a 2.5% decline in real wages compared to the previous year, and this was quite a significant drop compared to the 1.8% decrease we saw in the previous month. For the first time in a number of weeks, we saw some positive news out of the Chinese market. We got a very positive boost as optimism grew around some very strong holiday spending that we saw over the recent labor market holiday. According to data from the Ministry of Culture and Tourism, tourism revenue during the 5-day break increased by 7.6% compared to 2023. And that far exceeded pre-pandemic levels. So we're starting to move in the right direction as far as consumer sentiment is concerned. There was also a significant increase in domestic revenue with growth of almost 13% compared to the previous year. In addition to this, there was a notable uptick in international trips as well. In further positive developments, the private Caixin S&P Global Survey of Services activity also recorded a reading of 52.5. This was slightly lower than the previous month's one, but still pretty much in line with expectations and still indicating that, we are seeing some growth in the sector. On the trade front, also positive. China experienced a 1.5% increase in export compared to the previous year. This was indeed a significant improvement from the 7.5% decline we saw in March. Exports to Southeast Asian nations were particularly strong, with shipments to the European countries experiencing a slight decline, but nothing to really rock the boat. Imports in April also saw a noticeable increase, being up 8.4%. This was far ahead of expectations, and it was a complete reversal of the previous month's decline of 1.9%. With both of these readings being very positive, analysts are a little bit hesitant to entirely attribute this to a complete change in sentiment, and it was probably more attributable to a rise in the raw material shipments. So just looking at market performances, the Shanghai Composite Index gained around 1.6% for the week. Blue chip CSI 300 index was up 1.72%, and in Hong Kong, the Hang Seng added about 2.64%. And then bringing it back home, after some positive data we saw out last week, the performance of the manufacturing sector in March fell significantly short of expectations. This has actually started to heighten concerns about the possibility of a contraction in GDP during the first quarter of this year. So after 5 months of growth in the manufacturing sector, there was a decrease of 6.4%, following a very strong increase of 4.1% we saw in February. One of the main reasons for this decline was the significant decrease in production within the automotive sector specifically. The production of motor vehicles, parts, and other transport equipment experienced a sharp decline of 26% in March compared to the same period last year, and this had quite a large impact on the decline in the manufacturing output overall. What is interesting to note is these were the numbers for March, which was prior to the latest suspension we'd seen in load shedding. So it'll be interesting to see how the April numbers comes out. Just looking then at the performance of the local market, the all-share index was actually up 2.66% despite some of the bad news we got out of the local economy. This was mostly driven by the resources sector, which was up more than 5% on the back of some strong commodity prices, as well as the general sort of risk-on sentiment that we've seen globally. On the back of this, the rand also